We're joined now by Alex Holmes. He is Senior Asia Economist at Oxford Economics, speaking to us from Singapore. Alex, good to have you with us. No, we're not expecting a technical recession, but the economy looks like it's barely going to grow this year. Your report says that Singapore's government likely to downgrade its full-year forecast. Is that as bearish as it gets? Any bright spots?
There's certainly bright spots, but and there's a lot of push and pull factors going on at the moment. So some bright spots, some really not so bright spots. But given that Singapore is such a trade-dependent place and exports are so important to its GDP, the fact that external demand has been rather weak is really weighing on the manufacturing sector and offsetting all of those bright spots from tourism.
So we know that Singapore is very reliant on external trade, but what are the biggest macroeconomic challenges at this moment? What headwinds is Singapore likely to face?
Yeah, so there's been several factors driving the downturn in trade. There's been the normalization of consumer spending habits globally since the pandemic. People have spent less on goods and more on services. That's weighed on import demand. There's been a downturn in the electronics cycle that may be reaching a bottom, but probably won't pick up very quickly from here. And then finally, there's this kind of general downturn in global demand, which we think is still to come. Really, monetary policy has been tightened a lot, particularly in Western economies, the US and the Eurozone, and the lagged impact of that is still feeding through. And as those economies slow, that will weigh on import demand. And means really that the chances of a strong pickup in the second half of the year or even in 2024 are rather slim.
Interest rates surely to play a role as well. I mean, central banks from major developed economies aren't likely to cut rates anytime soon. Does that mean that Singapore's benchmark rates are also likely to climb higher towards the end of this year?
Yeah, so the Fed meets late this month, and most people, including ourselves, expect them to resume their tightening cycle. Singapore's interest rates follow those of the Fed. And so it means that the benchmark interest rates in Singapore are likely to rise more and reach higher points over the coming quarters. And that's going to weigh on business investment. It's also going to hit consumption as people have to spend more on servicing their debt and new credit is more expensive.
Where do you see inflationary pressures? Is it going to ease towards the second half? What about price pressures from higher wages? I mean, right now we're seeing core inflation significantly lower at between 2.5% to 3%.
Yeah, so if there's a little bit of space for optimism, that's where we would see it. Price pressures have already started to come down quite a bit. Inflation is still elevated, 5.1% at the headline and 4.7% core, but it should gradually continue to decline, partly because of the lagged impacts of falling import prices. And those underlying pressures of tight labour markets and high wages, well, the kind of weak economic growth is likely to mean that those will fade as well.
The central bank, the Monetary Authority of Singapore, has geared its policy towards the Singapore dollar's relative strength. But it's great if you're going to be using Singapore dollar to travel overseas to spend. But does that actually help tamp down some of the inflationary pressures here in Singapore?
Yes, it definitely does. Singapore imports most of the things it consumes, so a stronger currency pushes down the price of those imports, and that's partly why Singapore sets monetary policy in that way. But we do think that talk will soon turn to when the MAS might start to loosen policy, given the fact that economic growth is pretty weak and is likely to stay that way. Inflation pressures are falling back. It's not going to be immediate, but perhaps the early next year, we might see some signs from MAS that they're going to look to slightly loosen the pace of appreciation that they're targeting.
Singapore's non-oil domestic exports, any sign of a pickup anytime soon? I mean, semiconductors, integrated circuits, are they likely to benefit from an artificial intelligence boom?
So we get the data for June on Monday, but we're not expecting any kind of near-time pickup. There's a lot of buzz around AI, of course, but AI chips are actually a rather small part of the market There are many other sort of end uses for chips. So while we are actually seeing in some parts of the world pick up in demand for particular chips that are used for AI, it's probably not big enough to completely turn around the fortunes of the semiconductor sector. And while that sector has kind of bottomed out, we don't think that demand is going to quickly pick up the way it fell back sharply over the past 6 months or so.